Thanks for being here, guys.
Sure.
Thanks for having us.
So, Andy and Brian, you two and your firms are two of the big name investors in private tech, and it's an interesting time right now in the private tech markets. One of the big stories is this kind of marking down of private tech companies by mutual funds, Dropbox, Snapchat, Zenefits, et cetera. And actually, before we get to Andy, I want to start with you, Brian, and get your perspective as a VC on this. Your firm has had some companies that have been marked down. When you see that, what do you think of it as an investor? A lot of VCs, I think, are trying to make sense of it. Some are kind of brushing it off and ignoring it as much as possible. Others, kind of seem to love to talk about it. So,
Yeah, we don't sweat it at all. The venture capital is about finding the largest, most important companies that transcend any macro cycles, and what something marks something up or down. We don't necessarily mark up rounds, right? And so for us, what matters is building transcendent, extremely large companies, and we don't pay attention to what other people are marking things at, whether they be up or down.
In the short term, though, does it have any effect in terms of if you want to raise at a higher valuation in a few months or something, or any effect on employee morale or how executives are viewing things?
Perhaps, but I think most people recognize that markets go through cycles, and we're in a different macro cycle than we were, a year ago. And so for the companies, especially the companies that are mission-driven, which is a large portion of our portfolio, those employees are there to achieve that mission, and there's not really many other places they can go to do that besides these companies. And so, sure, it may play an impact for a lot of people. We haven't seen it impact morale on a large scale anywhere yet.
And so, Andy, how should we be thinking about this issue, journalists and investors and tech company founders, employees, what to make of all this?
Jumping right in there. Wow, no lead in at all. It's a big topic, but it's also pretty narrow. We make investments that we think are good long-term investments for our shareholders. We do have, the vehicle that we have are daily redeeming mutual funds. They're open-ended funds that trade every day. And so we do have a process by which a team other than the investment team needs to put a mark, and that mark needs to be there every day because these form a part of the funds. They're a very, very, very small part of the funds, but that fund is marked every day. And so there's a process that we go through to be fair to shareholders that are coming in and out of our funds. And that's all it is. It's a process to arrive at an appropriate mark that is fair for shareholders coming in and out of the funds. It doesn't mean that that's what the investment team thinks. It doesn't mean that if we mark something down, we're selling. It doesn't mean that if we mark something up, we're buying. All it means is that we're trying to find an appropriate price to manage our inflows and outflows.
And when a markdown does happen, kind of the same thing happens on our end every time. If a company gets marked down by 30%, 40%, we'll call the company. They'll say, this is just a reaction to the markets. It has nothing to do with us. The multiples are coming down, and this is just all public market driven. How often is that the case, and how often is it company related, performance driven?
So when they come up with a valuation, they take a lot of information into account. Some of it is the public markets. The public markets are the best vehicle for determining value that exists. That's just a flat statement. And these companies that we're valuing are different than public companies, but they're also in a similar space as the public companies. So, if we just divorce it a little bit from a tech company, if we were invested in an oil and gas firm, which we've done, we invest across all sectors, not just tech, and the price of oil drops, that's an input. We need to think about the valuation that we have in a an oil and gas company, and it would probably cause us to mark down. So there's company performance, historical, there's company performance projections, there's the market, there's what competitors are doing, there is turnover at the company, there is quality of people. There's a lot of inputs that go in. And so it's hard to say X% of the time it's because of this. Actually, it's very rarely that a mark is solely due to one thing.
And has it kind of affected any of your negotiations in terms of putting in new money into new companies? Are there founders who are worried about this, about having their share price out there for everyone to see?
It's definitely been a greater topic of discussion. I think folks, before we invest, want to understand the process, want to understand what inputs do go in, when, how frequently it's done, how it's done, who's doing it, and it surfaces a great conversation. Companies that really want to go public and want to be a large public company, be very, very, very successful in the public space, they have a different line of questioning than folks that are really thinking their exit is an M&A exit. And what we're looking for is not to invest in a company that is going to be sold in a year or two. That doesn't really help us. What we want is to invest in a company that will grow and we can continue to deploy capital, maybe another round, maybe on the IPO, maybe in subsequent public offerings. You know, the big success for us is we put $50 million in now, and we continue to invest money, and in 3 or 4 years from now, 5 years maybe, we look back and say, wow, we own $2 billion of this company. It's been great, and we're going to own this for the next 10 years. That's a really good success story for us. Putting $50 million in and having the company sold, and maybe we double our money, that's a good financial result, but it doesn't really help us move the needle for our shareholders, because again, these are pretty small. We're trying to get to know some of these companies where they will be very large public companies. So you can kind of suss out a little bit of the way the questions are asked, whether the company truly wants to be a public company.
What would one of those questions be?
Well, one is I don't want any of my valuation to ever be public. Then we would say you realize that this will change every second when you're a public company. So having it come out every month is a stepping stone. You can kind of tell the direction of people that are really, really, really nervous about it are not ready in their minds yet to be down the path of being a public company.
Brian, Founders Fund just raised $1.3 billion for a new fund. It looks like a lot of some of the top tier VC firms have done really big raises right now. It seems to me that it's, a lot of people are telling me it's easier than ever to raise money from LPs. Do you get that sense, and what are the plans for the next fund? What can you tell us?
I mean, I never take raising money for granted. But LPs care about performance, and they care about historical performance, and that's the number one thing. So I think if you have solid numbers to back up what you're doing, I think it is easier to raise capital from LPs. That's what they want. And so, fortunately we have some good numbers, but no, we still pound the pavement. We really like our LPs. We respect them. And so, yeah, we meet with them quite often. In terms of plans for the new fund, nothing different than what we've been doing. Totally stage agnostic, totally sector agnostic. We don't do sidecar funds. It's all one fund. We take advantage of any opportunity that comes our way, whether it's we write anything as low as $1 million check to our largest check is $200 million so far. And you need a fund size to be able to support that. But yeah, we're not hesitant to put 20+% of a fund into any one investment. So we need to be able to be truly sector agnostic.
So where do you, can you talk a little bit about your thought process in terms of where the growth opportunities are right now and how you look forward if you are sector agnostic?
Totally sector agnostic. I'm open to anything. that can be one of the world's most important companies. Again, the venture business is all about the massive hits, right? And you never know what the world's most important companies are going to look like. I can tell you. So Facebook was an amazing company for us. It's an amazing company. It's one of the most important companies ever in the history of the world. The next Facebook will look nothing like Facebook, right? So if you're sitting there and you're sector dependent, you're not going to find the world's biggest companies, and that's what this is all about. I see some of our portfolio companies in the audience today. We share some investments in some of those what we think could be next generational companies to come, but I never say a specific sector that I'm looking at, because then it restricts you. And why would you want to restrict yourself?
How do you view kind of this slowdown in terms of some valuations coming down? Do you see them coming down more, and where specifically?
I don't know what the future holds on that. We do see valuations coming down. The great news is, again, transcendent companies are built regardless of what the macro cycle is. So all it means for us is that maybe you get some good companies, some great companies, and maybe you pay a little bit less for them, right? But there's no slowdown for us in investment in the great companies, right? That's the important thing, is that for us, there's no slowdown on that side.
It's a good thing for investors and for you then that prices are coming down?
I mean, I don't think it's good or bad, because we're going to invest regardless of the cycle. We're going to invest when when the macro trend is that things are expensive. We're going to invest when the macro trend is like now. And so as long as we're consistent, for me, venture capital is less about macro and more micro. The macro in some ways doesn't matter, right? It's a weird statement, but when we invest in these companies, as Andy was saying, we're investing for hopefully 10 plus years. That's going to transcend multiple cycles. I was around for the 2001 stuff to the 2008 stuff. Now, like any massive investment that you have is going to transcend multiple cycles. And so when you're investing for the long term, there's no good or bad. Your job is still the exact same thing. Find the world's most important companies, and the returns will come.
Andy, where's your view of where we are in the cycle and where the opportunities are? Do you look at specific sectors? How are you guys thinking about this?
Well, no, we look across all sectors. Obviously, the most opportunities we see are in technology, life sciences, but we do see financials, we do private real estate, we do private industrial, and we look globally. So there's opportunities everywhere. We're probably a little bit more opportunistic than Brian. I mean, we don't do venture capital. What we are doing is, late stage companies that we think will go public. Our bread and butter is the public market. So what we want to do is invest in companies that will come into the public market. They can be on our pad. We can trade them. We can, have a great experience with them over a very, 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 very long period of time. And so it really comes down to the entry point. Lots of companies we see, we love the business. We will definitely be a shareholder of that company. The question is just when is the appropriate time for us? And the entry point is, there's many entry points. There's going to be the IPO, there's going to be follow-ons, assuming everything is priced accordingly, and maybe private rounds. But we can always wait. For companies that are going to be around for 10 years, we can always wait.
How about internationally? In terms of Fidelity's private portfolio, I don't think that you guys have any investments in India, for instance. Why is that?
Good question. We do have international investments. We have investments in Europe and in Asia. We probably just don't have as much experience in India. We don't have an office there. We don't have people on the ground there. It's probably a little bit of a higher hurdle for us. We don't have dedicated capital looking at India, whereas we do have dedicated capital looking at Asia. I have analysts on the ground there. I have people on the ground. I have traders there. In Europe, same thing. So it's probably just a little bit further afield for us.
Brian, I don't think Founders does international investments. Is that something that could come up with this next fund?
We certainly have had international
I
investments.
stand
Spotify was international investment. DeepMind, which is acquired by Google. That was an England-based, based in London investment. So we do have international, but we go where we know we have an advantage, right? And I think similar to what Andy was saying, like we don't know the rules everywhere as well. And so we go where we think that we know the space, we know the area, we know the rules better than anybody. And so we tend to play, primarily in Silicon Valley, but primarily America as well.
In terms of what the landscape looks like right now, there were a lot of companies that achieved billion-dollar-plus valuations in this last run-up. I'm curious to know, Andy, how many unicorns do you think are worth investing in at their current price? Like what percentage?
I don't know. The unicorn is the name. Well, the name is a misnomer because there should only be one or two of them if there really were a rare animal. It's just a valuation number. A lot of these companies, had they existed 10, 15 years ago, they would be public companies, and they've just decided, for a variety of reasons, not to be public. Just because they're private, and Fidelity is worth a lot more than $1 billion. It's a private company. Nobody writes about that. So it just... It really is irrelevant. I'll tell you, I got a good question. Actually, I'd like to hear Brian's answer to this. I'll answer it first, and then I'd love to hear your answer. Somebody in a panel asked me, if you add up all the value of the unicorns, it's something like close to Facebook's valuation. Would you rather have a pro rata share of all the unicorns, or would you rather have an investment in Facebook? And that's a really tough question. Some of these unicorns will be fabulous companies, absolutely fabulous companies. They will change the world, and some of them won't. Facebook is a fabulous company too, but when you put that into context, all the unicorns added up, same valuation as Facebook. It's not like they're that this is something that is super unusual. Hasn't existed before, but these companies could have been public, and then we'd be talking about the valuation of all these small cap companies. I don't know. I would probably take the unicorns.
Why?
More shots on net.
Facebook is still a portfolio company of mine. I don't pick between my different portfolio companies. I'm a huge believer in anything that we still have and that we're still in our portfolio. And I think Facebook is one of the most transcendent companies in the history of companies. And I think some of the other companies in our portfolio, when we're talking about things like, SpaceX and Palantir and stuff, things like this, I think those will also be some of the most transcendent companies in the history of companies. So I like both.
In terms of VCs are always asking this question, what's next? And there's a lot of chatter right now about AI and VR and AR. And I was thinking about this recently because Fidelity has done some big investments fairly recently in WeWork and Oscar, and that makes a lot of sense because you guys have this kind of public market expertise in those industries, in real estate and healthcare. If this kind of next group of high-value private companies that might go public someday are kind of more emerging technologies, how does that kind of affect what you do, and do you have the expertise to kind of discern in those areas?
I'm not sure I followed that exactly, but I would just say we don't do what Brian does. We're not venture capitalists. We're not in the game of trying to figure out what will be the next absolutely groundbreaking technology based on a pitch book or an idea. What we're doing is looking at good, solid investments, long-term investments for our shareholders. I mean, at the end of the day, we run retirement money. We are trying to make good financial investments for our shareholders. So I don't think we get into what Brian does. So I'm not sure. Maybe once in a while, people will look after the fact and say, well, point one little thing or two little things that we've done. But by the vast majority of what we are doing is investing in companies that we think are going to be successful, large, public companies.
I ask in part because you recently invested in Magic Leap also, which is an AR company, doesn't have a product yet, or, I mean, how is that something that is definitely a successful public company based on kind of solid business metrics?
So I won't comment about any particular company, but there are times where we invest in companies where we feel that they will be successful public companies. We think there's a lot to learn about the company before it becomes public, and we want to get to know the company. It's making impacts in the public space, so part of what we're trying to do is understand, in order to understand any space, we don't want to just look at the public companies. We'd be missing something. So we want to look at the private companies too, and we really want to understand a space. And when we find a company that we think is an attractive investment and we think is going to be a very large company in the future, then we want to be able to make that investment. Sometimes we look at companies, we get a lot of information about companies. We have a good idea of what we think a public company will look like. And when we come across that and it's an attractive and we think it's good for our shareholders, then we'll make the investment.
Brian, Founders has several companies that I don't believe have taken mutual fund money yet, but seem like good candidates to. Wish is an example. Is there any kind of concern, at least on the margins, about some of these concerns that we talked about in terms of your share price being out there and maybe some headaches from kind of more public scrutiny of a company? If Wish, for example, wanted to take mutual fund money.
No, we have no problem having these guys as co-investors. We're in several companies with them. One thing from a venture capitalist standpoint that we love is that these guys are hands-off. I mean, the way to deal with the best companies in the world is let the founders run their companies. And when Fidelity, Fidelity is a financial investor, right? They're not telling you how to run your company. They're a financial investor, and they play those numbers. And that's great. The best founders in the world are just totally fine with that because it lets them run their companies. So we don't ever advise for or against specifically on other firms. We let the founders kind of make the decisions that are right for their business on that.
And just, there's been a lot written about this kind of most recent downturn, if you will, or the slowdown. I mean, we're journalists. I'm just interested to hear your thoughts on what you think journalists or the media are getting wrong about this part of the cycle.
Wow. Well, my only media comment, and this organization it doesn't really apply to this organization, but I think this was brought up in the Politico panel, which is most media seems to be about clickbait these days, and that seems to be and most people just read headlines, and so I think when you just read clickbait media headlines, that's a problem because it doesn't actually reflect anything other than people trying to get clicks.
What's an example of that?
I don't know.
Andy?
I second Brian's remarks.
We've written a lot about deal terms and structure and kind of these protections that investors are getting a lot of times in later rounds that might affect who gets what in a devaluation. Andy, how do you think about investor protections? Is it something that you demand? It seems to me that your philosophy is a little bit different than, say, a TPG or something.
I don't want to comment on other investors, and each situation is unique. We like downside protection. I mean, I want perfect downside protection and unlimited upside. But I guess maybe what makes us a little bit unique is we also want we want a fair deal, and two, we like simple deals. We would like a fair valuation and reasonable terms. What we don't really like, it's just not good for us. Again, if we run close to $2 trillion, and if I'm making a $25 million or $100 million, I can make a $500 million investment. It's important money, but it's our shareholders' money, so we're very careful about it. But what I don't want is people coming to us constantly. I want to give an option to this person. I want to give an option to that person. I want to hire a new auditor. We're not hands-on. We don't take board seats. We look at the board. It's very important to us who's on the board, and we trust folks like Brian are watching out for all shareholders as fiduciaries. So we don't put a lot of covenants and things in there where you have to vetoes that you have to come and talk to us in order to run your business. We don't want hundreds of vetoes every month. So maybe that's a little bit unique, but I would say every situation is unique. Some of our deals are more highly structured than others.
Do you see any of the leverage kind of changing in terms of who has more of it?
It's hard to say. Again, each situation is unique, and for the really great companies, they have a lot of leverage, and investors have a lot of leverage. So it's hard to handicap a negotiation about which side, A or B, is the pendulum is moving.
Did this become an issue at all in the markdowns? Because it is something that we heard about in terms of companies having discussions with mutual funds about investor protections and whether they might have some kind of effect on valuation.
Terms of the investment are definitely one of the inputs into the valuation.
And when the markdowns did happen, were there any kind of discussions about whether changing those would affect markups, markdowns?
Off the top of my head, I can't remember. I can't remember any situation where someone has come to us and said, we're going to change all your terms so that you will change your valuation. I mean, we'll have any conversation, so if people want to have those conversations, we'll definitely have the conversation, but we've never gone down that path. We've never had that.
Brian, how do you view investor protections when investors come in later and put them in? Talk a little bit about.
Yeah, to me, and this is a great case in which, a venture capital firm and Fidelity are probably a little bit different. Venture capital is about upside maximization, right? I totally understand why downside protection on these, $500 million, $1 billion checks are very important. For us, I would always trade more upside in a great company in exchange for less downside protection in a not as great company. Because at the end of the day, if you make a $10 million investment out of a $1 billion fund and that you have to write that off, that's not great, but it's not terrible compared to maximizing another 50% on, let's say Airbnb for us, right? And so we are in the game of upside maximization. So, and companies need to raise capital. So companies need to raise capital on whatever terms they can raise the best capital at. And there's no rule, and there's no one right way to raise capital, and there's no one set template for this either. And so to us, as long as we find the best companies that have the most upside, we're going to win.
I think it's time now to go to questions in the audience. If anyone has a... Please come to the mic.
Hi, Andy. I'm curious. I have sort of an organizational question. The private investments, are they being evaluated and run by the same people who run the public money? Is it better to have separate teams or have the same people doing both or a little bit of each?
So it's a good question. I'll tell you what we do. So we do have a dedicated team that evaluates private companies. We leverage all of the public company personnel. So we have over 100 analysts. We have almost 100 portfolio managers. I don't know. We have a lot of traders. We have a lot of people all around the world. We're a very big organization, and so what we try to do is leverage the experience. If we look at, I always use a chemical. Someone brings us a chemical plant. We have a guy who's, chemical engineer, who's been doing chemical for 20 years. It'd be crazy and so my team is the private investment team. We may not have all the chemical expertise, but what we'll do is we'll bring that person into the meeting and we'll leverage all of his expertise. And so I think that we're trying to marry both. So some private expertise and some of the public company guys who don't understand the small, high-growth companies, but definitely understand the industries. I mean, these are guys and girls that are vertical, that have spent a lot of time and really understand their business. And then we also have the portfolio managers can make their decision on an individual basis for each of their funds. When we find an attractive investment, we serve it up. And so my team says this is a great investment. Portfolio managers can say, I have 5 funds maybe. I want that in 2 of my funds, but not in the other 3. And in those 2 funds, here's the size weighting that I want to weight it. And every portfolio manager for every fund can make that decision. And then there's also a management level that oversees to make sure, is this appropriate for the fund? Is it appropriate for the fund's mandate? There's a process in which there's a lot of people that are involved. And at the end of the day, these are very small investments in the funds. We're talking about very, 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 each investment is basis points, so a fraction of 1%.
I have a question about your global investments. The information recently had a really nice series of articles about startups in China and about kind of the excitement that's going on in China. And that kind of contrasts with Anbang's recent failed takeover attempt with Starwood. I was wondering, do you guys have any thoughts or hesitancy on investing in Chinese startups despite the excitement due to potential issues with going public or M&A opportunities?
For both of us, I guess. Do you want me? I'll go first. China's probably anywhere that is a little bit further afield from where we are is a higher threshold. We're very comfortable in the U.S. We're very comfortable, I guess, North America, comfortable in Europe. China has different rules, and they're very different. And being in a public equity, if you figure something out, this isn't right. As long as it's a liquid stock, you can exit, and that's what we do. That is our bread and butter. The private investments, they're illiquid. We need to be able to hold them for a long period of time. It's just a higher threshold for us to make an investment in jurisdictions, geographies that we're not as well versed in. We do it, but it's a higher threshold.
Yeah, I mean, same for us. We want to invest where we know the rules. I think there's huge growth opportunities in China, clearly. That's not up for debate. But yeah, we want to, and we're exploring, and we're getting great information from the information on this. But no, we would only go in a big way once we really, really, really understood the rules.
Well, thank you both for your time.
All right, thanks, guys.
Thank you.